Well, there's odds makers. Just like if you were to go take a look on DraftKings and see what the odds are in a football game, well, there's odds makers on what the Fed will do as well. Just like we feel that there's just a 7% chance by January 31st, they'll start cutting. Remember, we thought the core PCE would be at 2.87%. So we just don't think there's going to be enough there for the Fed to start cutting. But certainly by March, we think, and the majority of market odds makers think that the Fed should cut by the March 20th meeting. Then as you can see here, chances are pretty much assured that by May, we'll get the first rate cut. In fact, there's pretty good odds that we'll have multiple rate cuts by May and June. 56% chance of at least a 50 basis points cumulative by June. And then there's a better than 50% chance we'll have 3 25 basis point cuts by that June 12th meeting. Now let's get into the mind of the Fed. So what the Fed does is anonymously, they plot these dots. Each dot, this is 2023, this is 2024, 25, 26. This is where the Fed thinks each Fed member, this is anonymous, thinks that we'll have the Fed funds rate. So right now, the Fed fund rate is between 5.25 and 5.5 on the Fed funds rate. So 2 Fed members think that there should not be any cuts in 2024. One thinks we should have at least a 25 basis point cut. About 5 of them look at 50 basis points. It looks like 6 say 75 basis points, 4 say 100, and 1 says 150 basis points. And that cut is rather significant. So the bias here is towards at least 3, maybe 4 rate cuts in 2024. But let's look ahead to 2025. Notice something? And notice something again in 2026. See the trajectory? Look, if you survive the tough year of 2023, well, congratulations, because now you should get a tailwind. You should see lower rates in 2024 and lower rates again in 2025 and lower rates again in 2026. Think of what that's going to do for refinances. Think of what that's going to do for the purchase market. You should be looking at buying right now. It's a golden opportunity because you can buy that home now. And as the interest rate market gets more favorable and rates decline, it should boost prices. And then you're going to have opportunities to refinance to a lower rate. It's really the best of all worlds. Now, something that's very important to watch is the Fed's balance sheet. Because we talked about supply and demand, and what's been hurting rates through most of 2023 is the Fed reducing its balance sheet. They had their balance sheet go up during the great financial crisis, certainly, and then it got up much higher during the COVID crisis to a point of $8.5 trillion. And that was just too much. And the Fed said, we're going to have to start to offload this. And they've been successful. These are their outright holdings of treasuries and mortgage-backed securities. And they've offloaded $1.4 trillion so far. And that's been a big move lower. And this Fed feels pretty good about this. But it came at a cost. As they were doing this, interest rates started to rise. Now we have to absorb all this. But recently, interest rates have gotten better. And that's because the expectation for lower rates is causing banks to aggressively be buying treasuries and lock in the higher rates in anticipation that rates are going lower. So let's take a peek here at what the Fed might be comfortable with on their balance sheet, because what will be critical is when the Fed is going to slow down or eventually stop that runoff and stop that added supply of treasuries and mortgage-backed securities in the market. So let's look at some history between 2014 and 2018. That was a 5-year period. The average that they held on their balance sheet was much lower than where it is at the peak. It was at 4.25 trillion. Now our GDP at that time was 19 trillion. So it was about 22% or so, between 22 and 23% of GDP. Before COVID, notice that the balance sheet went up. But because GDP went up, the percentage came down. So we were good with that. But at the peak at around 8.5 trillion, even though our GDP went up significantly, it was just too high of a percentage on the balance sheet of 33%, and they had to offload it. So here's where we are now. Again, they've offloaded, and this has gone from roughly 8.5 trillion to 7.1 trillion on their balance sheet. So they've dropped off a lot, and our GDP has gone up. So the percentage has come down from 33 to 25, but still probably above the Fed's comfort zone. So how will this transpire? Well, we know what this is because we already know what the runoff's going to be, but we can only take a reasonable guess at what GDP will do. And here's what the numbers look like. So as we go through each month, you can see that as we get into the March area, right before the March 20th meeting from the Fed, it'll be below 25%. We kind of think that that's too high of a number for the Fed to be comfortable with, and they'd like it to be lower. Now, the Fed may cut rates on March 20th, but I still think they'll continue to run off the balance sheet, so we won't see the full benefit here. As we go into the May meeting, it'll get under 25%, certainly 24.5%. June, it gets near 24%. But now, when you start to see what happens the second half of the year, you get to a level that the Fed is much more comfortable with. And we think that this is a good time, the second half of the year, especially ahead of the election, to get pressure to say, hey, we've got to slow down the balance sheet. As they do, as they slow down the balance sheet, and as they put themselves in position to do so, if they overshoot, we'll get a recession. And you can see here, mortgage rates during these shaded areas of recession, mortgage rates decline during recessions. But the Fed's balance sheet will be a critical component because less supply in the market means that interest rates should improve because the buyers will be bidding on fewer amounts of paper or supply that's available. Okay, folks, so what's our rate forecast for 2024? Well, for 2024, we see 30-year fixed rate mortgages in the mid 5s to high 6 range. Under 6% on mortgages should unlock move-up buyers and create more activity. The 10-year Treasury, well, we see it between 3 and 4.4%. We start the year just a little above 4%, so we think the overall trend, while that might move up and down a little bit, and it's certainly not going to move in a straight line, the overall trend will be to gravitate towards 3%. And we may even get a more normal return to the spreads between treasuries and mortgage rates, which is around 2%, not 3%. So that should also help mortgage rates reduce as well.